The Federal Reserve cut interest rates by a larger than usual half percentage point on Wednesday. Fed Chair Jerome Powell said it was aimed at boosting a cooling job market while continuing to push down on inflation.
This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%.
But what will the first rate cut in 4.5 years mean for everyday consumers? The central bank said it doesn't see the policy rate returning to the sub 2% levels that prevailed for more than a decade before 2022. That means that era's low mortgage rates, often under 4%, aren't coming back anytime soon. But the rate cut could start to ease some financial pressures. A lower policy rate should translate to cheaper borrowing costs for most kinds of loans, while on average, paychecks are now rising faster than prices, as inflation has cooled substantially. Even so, each trip to the grocery store is a reminder that today's dollars don't go as far as they did just a few years ago. While the rate cut comes as hiring and wage growth have slowed, Powell says he thinks the economy remains on solid footing.
I don't see anything in the economy right now that suggests that the likelihood of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels.
Policymakers see the Fed's benchmark interest rate falling by another 0.5 percentage point by the end of this year, and another full percentage point in 2025, which would bring them down to 3.25 to 3.5%. The next Fed policy meeting takes place in November.
U.S. stocks closed down in choppy trading on Wednesday after the Federal Reserve cut interest rates by a relatively hefty 0.5 percentage point. The Dow, S&P 500, and NASDAQ each lost between 0.25% and 0.33%. The Fed's announcement initially sent the indexes climbing, with the S&P and Dow hitting intraday highs.
Bravo, Jay Powell. Bravo.
Eric Ditton, president and managing director of the Wealth Alliance, cheered the Fed's decision, but believes the central bank should have acted sooner.
I've been really a champion of Jay Powell. I've been saying the Fed's medicine's working. I've seen inflation come down, but I really wanted him to cut last month, and he didn't. And so I would have been upset and disappointed if he came in at 25 bips. He came in at 50, 100%. That is the right move, and we're just beginning.
Markets are now fully pricing in a cut of at least 25 basis points at the Fed's November meeting, with a roughly 35% chance for another 50 basis point cut. Small cap stocks, seen as more likely to benefit from a lower interest rate environment, moved higher, with the Russell 2000 index outperforming the S&P 500. Regional banks, some of which had been stressed by higher interest rates, also gained ground, with the KBW Regional Bank Index jumping as much as 3.5% before closing up about 0.5%. Other notable movers included shares of Intuitive Machines, which surged more than 38% after the company clinched a $4.8 billion navigation services contract from NASA.
Sir, what's your reaction to the Fed cutting interest rates today?
I guess it shows the economy is very bad to cut it by that much. Assuming they're not just playing politics, the economy would be very bad, or they're playing politics, one or the other. But it was a big cut.
Mr. President, any reaction to the Teamsters' decision not to endorse?
No, they were. It's a great honor. They're not going to endorse the Democrats. That's a big thing. And this is the first time in, I guess, 50, 60 years that that's happened. Democrats automatically have the Teamsters. They took a vote, and I guess I was at 60% or more, and that's a great honor. I mean, it's really, I've had a lot of Teamsters work for me, a lot of the concrete trucks. They built all these buildings that you see in New York City, the Teamsters, exclusively Teamsters, I have to say. They've done a great job, but the vote of the Teamsters themselves was very high for me, and the leadership, Sean O'Brien and the group, who are great people, they said we can't endorse the Democrats. So I think this is the first time in many decades that they haven't endorsed Democrats.
Big difference in those big industrial states, you think? They're going to make a difference?
I think it will, yeah, I think so. The Teamsters carry a lot of weight. The Democrats cannot believe that. And, look, this is, it was always automatic that Democrats get the Teamsters, and they said we won't endorse the Democrats this year. So that was an honor for me.
Mr. Trump, there's a lot of concern about your vulnerability as you golf. Are you going to continue to golf? And have you talked with the Secret Service about upping?
Well, we'll
security?
look at it and we'll do what the Secret Service wants. You don't want to ever be curtailed because of the crazy people out there, the bad people, crazy people, whatever you want to call them. So we'll let the Secret Service determine that. If they think things are safe, you do it. Like coming to a place like this, it's got to be safe. It's got to be safe. We're going now to Nassau Coliseum where, it's literally been packed. It's been, incredible. They have over 60,000 people for 15 or 16,000 seats. So I look forward to that. But it's always got to be safe.
We got some great.
You just don't want them dictating to you where you should go and what you should
do. You
do.
feel kind of hemmed in by all the new security?
No, I don't. I really don't. I just have to lead my life, and I have to make America great again. That's what it's all about.
Sir.
Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a 0.5 percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance.
Bravo, Jay Powell. Bravo. I am very happy. I've been saying for a while here that Jay Powell got a little behind the curve. If inflation's at 2.5, and you tell me that you want to be Fed funds 0.5 to 1.5% above that, that's 3 to 4%. What you doing over 5? And we're seeing a cooling labor market. So I've been really a champion of Jay Powell. We've been saying the Fed's medicine's working. We've seen inflation come down, but I really wanted him to cut last month, and he didn't. And so I would have been upset and disappointed if he came in at 25 bips. He came in at 50, 100%. That is the right move, and we're just beginning. But I really think the markets needed to see the 50 basis points to just move us up here. We really got behind the curve. Look, he's got a dual mandate, right? He wants close to full employment as he can get with stable prices. That's what he's balancing. And he finally said, we are now in equilibrium. I've been more worried about inflation until now. Now I'm equally worried about the employment picture as I am about prices. And that's good. We need to hear that. And what we're talking about now is a median estimate by his people in the Fed of 4.4% on the Fed funds by year end, 3.4 end of next year. Stock market, by the way, popped. And I was a little surprised because I just feel like this has been fairly baked in. The derivatives market said 2/3 chance of 50 bips. That's what derivatives were saying. We've had a nice market rally right up to today. And if you look historically, 3 months out from the first Fed cut, the S&P's up median 6.4%. It's 9.8% if you go out 6 months. And if you go out 1 year, it's north of 15%. So historically, this is the beginning of a bullish time.